Stocks and shares are often used interchangeably to signify ownership in a company. However, shares more specifically refer to the individual units into which a company's ownership is divided, while stocks is a broader term encompassing various types of ownership securities, including common and preferred stock. Common stockholders typically have voting rights at shareholder meetings and may receive variable dividends, while preferred stockholders often lack voting rights but have a higher claim on the company's assets and receive fixed dividends. In casual conversation, people often use both terms without distinguishing between the two, referring to the general idea of owning a piece of a company. Understanding the subtle differences between stocks and shares is crucial when considering the specific rights and benefits associated with different types of ownership securities. Here's a more in-depth look at both terms. First one, stocks. Stock is a broader term used to represent ownership in a company. When you say you own stocks in a company, you're generally referring to a broader category that includes various types of ownership securities, including common stocks, preferred stocks, blue-chip stocks, income stocks, growth stocks, value stocks, small cap, mid-cap, and large cap stocks, cyclical and defensive stocks, tech stocks, dividend stocks, REITs, real estate investment trusts, foreign stocks, ADR, GDR. And let's talk more about this various types. First one, common stock. Common stock is the most common type of stock issued by companies. Common stockholders have ownership rights in the company and typically have voting rights at shareholder meetings, allowing them to participate in corporate decisions. They may also receive dividends, although these are not guaranteed and can vary in amount. Second, preferred stock. Preferred stock is another type of ownership security. Preferred stockholders usually do not have voting rights, but they have a higher claim on the company's assets and earnings compared to common stockholders. They receive fixed dividends, which are paid out before common stock dividends. Third one, blue chip stocks. Blue chip stocks belong to well-established, large, and reputable companies with a history of stable performance. They are known for their reliability and are considered safe investments, often paying regular dividends. 4. Income stocks. Income stocks are shares of companies known for paying high dividends consistently. Investors often choose income stocks for regular income rather than capital appreciation. 5. Growth stocks. Growth stocks belong to companies expected to grow at an above-average rate compared to other companies in the market. These stocks often reinvest their earnings into further expansion rather than paying dividends, making them potentially attractive for long-term capital growth. 6. Value stocks. Value stocks are shares of companies that are considered undervalued compared to their intrinsic worth. Investors seek value stocks with the expectation that their market prices will eventually rise to reflect their true value. 7. Small cap, mid cap, and large cap stocks. Stocks are categorized by market capitalization, which is the total market value of a company's outstanding shares. Small cap stocks have the smallest market capitalization, mid-cap stocks are in the middle, and large cap stocks are the largest. Each category may offer different risk and return profiles. 8. Cyclical and defensive stocks. Cyclical stocks are tied to economic cycles and tend to perform well when the economy is growing. Examples include companies in industries like manufacturing and construction. Defensive stocks, on the other hand, are less sensitive to economic downturns and include sectors like utilities and healthcare. 9. Tech stocks. Tech stocks belong to companies in the technology sector, which can include everything from hardware and software to internet and social media companies. These stocks often exhibit high volatility and growth potential. 10. Dividend stocks. Dividend stocks are shares of companies that consistently pay dividends to their shareholders. They are favored by income-focused investors. REITs. Real estate investment trusts. REITs are a unique type of stock that represents ownership in real estate properties or real estate-related assets. They often provide regular income through dividends and are a way to invest in real estate without buying physical properties. Foreign stocks, ADR, GDR. American Depository Receipts, ADRs, and Global Depository Receipts, GDRs, are ways for investors to buy shares in foreign companies listed on U.S. exchanges. They enable investors to diversify globally and access international markets. The second one, shares. Shares specifically refer to the units into which a company's capital is divided. These units represent ownership in the company. When you own shares in a company, you are talking about the individual units of ownership that you hold. For example, if you own 100 shares of company XYZ, you possess 100 individual pieces of ownership in that company. In the context of stock market investment, shares refer to the individual units of ownership that represent a claim on a company's assets and earnings. Here's a more detailed explanation of shares in stock market investment. First one, ownership in a company. When you buy shares of a company's stock, you are essentially purchasing a piece of ownership in that company. The number of shares you own relative to the total number of outstanding shares determines your ownership stake or equity in the company. Second, ownership rights. Shareholders, by owning shares, typically have certain rights, including voting rights. Common shareholders often have the right to vote at shareholder meetings. Each share typically grants one vote, allowing shareholders to participate in important corporate decisions. Dividend rights. Shareholders may receive dividends, which are a portion of the company's profits distributed to shareholders. The amount and frequency of dividends depend on the company's financial performance and dividend policy. Liquidation rights. In the event of the company's liquidation or sale, shareholders have a claim on the company's assets, but they are typically lower in priority than bondholders or preferred stockholders. What are the types of shares? Companies may issue different classes of shares, such as common shares and preferred shares, each with its own set of rights and characteristics. For example, preferred shareholders often have priority in receiving dividends and assets in case of liquidation but may not have voting rights. Third, stock price. The price of a share in the stock market is determined by various factors, including the company's financial performance, market sentiment, supply and demand dynamics, and economic conditions. Stock prices can fluctuate widely over time. 4. Stock exchanges. Shares are bought and sold on stock exchanges, which provide a centralized platform for trading. Some well-known stock exchanges include the New York Stock Exchange, NYSE, and the Nasdaq. 5th. Market capitalization. The market capitalization, market cap, of a company is calculated by multiplying its stock's current market price by the total number of outstanding shares. It represents the total value of the company in the stock market. 6th. Liquidity and trading. Highly liquid stocks are easily bought and sold in the market with minimal price impact. Liquidity can vary depending on the size and popularity of the company. 7. Investment strategy. Shares are a common investment vehicle for individuals and institutions seeking to grow their wealth. Investors may adopt various strategies, such as value investing, growth investing, or income investing, depending on their goals and risk tolerance. 8. Diversification. Investors often diversify their portfolios by owning shares of multiple companies across different industries and sectors. 9. Risks and returns. Investing in shares carries risks, including the potential for loss of capital if the stock's price declines. 10. Long-term perspective. Many investors take a long-term approach to share ownership, aiming to benefit from the stock market's historical growth over time while weathering short-term market volatility. Lastly, regulation. Shares trading on stock exchanges are subject to regulatory oversight to ensure fairness, transparency, and investor protection. Understanding shares and their role in stock market investment is fundamental for anyone looking to participate in the stock market. It's essential to conduct research, assess your risk tolerance, and have a clear investment strategy before buying shares in specific companies. Additionally, staying informed about market developments and economic conditions can help make informed investment decisions. I hope you gain a lot of knowledge about stock market investments. Please like, share, and subscribe to our channel. See you in the next video.